The tax code is not designed to take your money. It is designed to make you wealthy if you know how to use it. After working with over 1,000 business owners, I can tell you something I see all the time. The people working the hardest often keep the least, not because they earn less, but because they are playing by the wrong rules. Give me about 10 minutes and I'll walk you through the incentives Congress built into the tax code, why they want you to use them, and how my clients keep millions more without changing their business, just their strategy. Let us get right into it. Here's what most people get wrong about taxes. They think the tax code is a punishment system. Work hard, make money, and get punished. And honestly, I get why it feels that way, but that is not how it actually works. The tax code is a reward system. The people who understand that are the ones who legally pay far less than everybody else. You've seen the headlines about companies like Amazon, Apple, and Facebook. You also have heard stories like Trump famously paying $700 one year. Whether you like those examples or not, the takeaway is simple. These are not people guessing. They're people using the system the way it was written. For more than 60 years, the government has used the tax codes to tell you exactly what it wants done. They need roads built, they need jobs created, they need energy produced, they need housing developed, they need food grown. And instead of doing all of that themselves, they incentivize you to do it through tax benefits. Most people assume 50 or 60% of their income automatically goes to taxes. And it does not have to be that way. Not if you understand what the government is actually rewarding. And the biggest reward in the system starts with job creation. Let us start with incentive number 1, job creation. Job creation is the government's number 1 priority, and they will pay you handsomely for it. When you hire someone, that is one less person the government has to support, one less unemployment check, one less strain on the system. That is why the tax code is packed with incentives for employers. But most business owners, especially in trades and home services, miss this completely. They look at payroll as a cost. They look at taxes as a punishment, when in reality, the government is often subsidizing you to grow your team. Let me make it concrete. Say you hire your first employee and you pay them $50,000 a year. Between payroll deductions, the work opportunity tax credit, and retirement contributions you can make on their behalf, you would save $10,000 to $15,000 from that one hire. That is the government paying you to build your team. And it does not stop there. The more jobs you create, the more incentives you can unlock. The more you grow, the more levers you have. Job creation is not the only thing they reward. Moving to incentive number 2, innovation and R&D credits. Most business owners hear R&D tax credits and immediately think it is for tech companies like the ones in the Silicon Valley. But a lot of real businesses qualify, including construction, trades, manufacturing, and professional services. If you have ever spent money developing a new system in your business, improving internal processes, building tools to increase efficiency, or testing new methods or materials, that can qualify. I work with a construction company that built a custom scheduling system for their crews, and they were not trying to do anything fancy. They solved a real operational problem, and it turned out to qualify for R&D credits, and they got back over $40,000. The government wants businesses to innovate and get more efficient. They're willing to pay you for it if you document it the right way. That is where so many business owners get stuck. They're sitting on credits they have never claimed because no one told them they qualified. Now, let us shift from innovation to another area with massive incentives. The third incentive category is housing and real estate, and it is huge. We have a national housing shortage. The government knows it. So the tax code is loaded with benefits for people willing to build, renovate, own, and operate real estate. If you own rental property, you can deduct things like property taxes, insurance, repairs, and improvements. And you can also get depreciation, which let you write off the value of the building over time. Here's when it gets interesting. Most people spread depreciation over 27 to 39 years. But with the right strategy, you can accelerate depreciation and pull a lot of deductions forward. I had a client buying a rental property for $500,000. With the cost study, we accelerated over $150,000 in deductions into year 1. Yes, $150,000 in tax deductions immediately. And if you're a contractor, a home builder, or a trades business owner, you are in a perfect position to use these incentives. You already understand the asset. You're already close to the industry. Most of the time, the only thing missing is the strategy and the paperwork to support it. Before we leave incentives tied to essential needs, let's talk about incentive number 4 is energy and renewable energy. This category is massive and it has been getting bigger. Oil, gas, solar, energy efficiency work all get attention in the tax code because energy is a national priority. If your business installs solar or you work in HVAC, roofing, electrical, or energy efficiency, you may already qualify for credits you have never claimed. Even homeowners can get a tax credit for installing solar panels. incentives. As a business owner, there can be even more opportunities depending on what you do and how you structure it. And here's one most people do not know about. Oil and gas investment can come with deductions that may exceed your initial investment in year one in certain structures. So you might invest $100,000 and see $100,000 or more in deductions in that same year. This is one of the most aggressive and legal categories in the tax code, but it has to be done correctly, and it is not for everyone. Even with energy being a big one, there's a category that often receives more incentive than anything else, and that is agriculture. By the time we reach incentive number 5, we have to talk about agriculture. Agriculture receives more tax incentives than any other industry in the tax code. Why? Because food is very essential. The government needs people farming, producing, and developing land. So they reward farms, equipment purchases, land improvements, livestock, and agricultural operations of all kinds. I've seen situations where people save more in agricultural tax benefits than they actually earned in income in that year. And that is how powerful these incentives can be when they apply. And here's the part most people miss. You do not have to be a farmer to participate in agricultural incentives. Some people invest in agricultural land, some partner with farmers, some participate in agricultural syndications. The incentives can be available if you know where to look for and you can structure it correctly. So now the big question is, how do wealthy people actually use all of this in real life? Here's what separates wealthy people from everyone else when it comes to taxes. To make sure every dollar they spend does two things. It lowers their taxes and it builds their wealth. A lot of business owners save money on taxes and then immediately spend it on something that loses value, like a truck, a boat, something that feels good but does not compound. Wealthy people take the savings and invest it. Let me show you what I mean. One of my clients saved $30,000 in taxes last year. Instead of spending that, he invested it in a retirement account and a real estate syndication. In 7 years, that $30,000 becomes $60,000. In 14 years, it becomes $120,000. In 20 years, it becomes over $200,000. He did not make more money. He did not work harder. He just stopped giving away and start compounding it. That is not magic. That is structure. And the structure that matters most for business owners is your entity setup. Here's one of the most expensive mistakes I see. A business owner set up an LLC when they make around $200,000 a year. It is very simple. It feels clean. They move on. And then 10 years later, they're making $3 million and they're still using the same LLC. It's like wearing the same shoes you had in middle school. They do not fit anymore. And they're costing you 5 figures a year at minimum. And here's what most people do not understand. An LLC by itself does not save you taxes. It's primarily legal protection. Tax savings come from how your entity is structured and taxed. And that can include an LLC, as an S corporation, can include an C Corp election in the right situation. It can include holding companies, trusts, multiple entities working together. And these structures can stack when they are designed correctly. They can pay each other. They can create layers of tax efficiency that a single LLC will never give you. But most business owners never revisit this setup. They just keep going and keep overpaying. And that leads to the real reason people overpay taxes. People do not overpay because they're doing something wrong. They overpay because no one ever explained the rules to them. You did not go to school to become a tax strategist. You built a business. You became an electrician, contractor, an attorney, or whatever your field is. And that's fine. You're not supposed to know all of this by default. But here's what you do need. You need a bookkeeper to track your numbers. You need a CPA to file your taxes. And you need an advisor or tax strategist to interpret the numbers and build a plan. Most business owners have the first two and almost none have the third. And that is where the money is, not the filing, in the planning. Which brings me to the principle that changes everything. If you want to change your taxes, you must change your facts. Your tax bill is not random. It is the result of your facts, your entity, your structure, your investments, your strategy, your team. If you want different tax outcomes, you need different facts. Let me give you a real example. I had a client come to me as a sole proprietor, no entity, no structure, no strategy, just working hard and paying whatever the tax bill said. We switched him from an S Corp, set up a retirement plan, and restructure how he paid himself. That one set of changes saved him over $18,000 in the first year. Same revenue, same business, different facts. So the question is not, how do I find a magic deduction? The question is, which facts do I need to change so that the tax code starts rewarding me? And that is where proactive planning comes in. Here's the truth most CPA will not tell you directly. Tax savings do not come from filing. They come from planning during the year, long before April. By the time you are filing, the game is already over. Decisions have been made and the facts are set. You want control? You need someone to understand your business model, your team, your margin, and your goals. Not someone who just enter the numbers into software once a year. And most of the mistakes I see in business doing $1 million to $10 million have nothing to do with revenue. They come from lack of structure, lack of planning, lack of advisory, and the wrong entity setup for the stage of business you are in. So if you feel like you're playing the tax game blind, that is fixable, but it requires a shift from from reactive to proactive. And now here's the thing, knowing these incentives exist is not enough. You need to know which ones apply to your business based on your revenue, your structure, and your goals. That is exactly what I break down in the next video. I'll show you how to audit your own situation, find the gaps you are missing, and start building a strategy that actually fits your business. Because once you understand the rules, you stop playing defense, you get clarity, you get control, and you get a roadmap you can build on for years. Click here and I'll show you exactly how it works.